Hello, everyone, and welcome to session 3 of Financial Statement Analysis series. My name is Shailesh, and I will be walking you through decoding revenue as a line item. Now, in our previous sessions, session 1 and session 2, we discussed how revenue figures are presented across the annual reports and how to calculate net operating revenue for any company and use it to judge the growth rate of that business. In this session, we will be understanding how companies define revenue. Now, we know that revenue is something which a company gets as a consideration for rendering their services or selling products to customers. What if, let's say a business were to manufacture a particular product, sell it, but it hasn't yet delivered that product. It is still lying in the godown or warehouses of that particular company. The customer may have already paid for it. Does the company recognize it as a revenue? What if customer has paid advance and the company is yet to work and create that product or render that service? Does that company get to recognize that as a revenue? Thankfully, we don't need to worry about these nitty-gritties because we have accounting standards who have well-placed guidelines, a set of rules precisely for these companies to follow and define revenue. Now, these guidelines have been made a bit more flexible for businesses to alter those rules depending on different industries, different businesses, natures of products and services to their comfort, sticking more or less to that guideline, which is precisely why an analyst needs to pay close attention on how a company is defining revenue. We are not implying that the companies will cheat always, or rather try to overstate their revenues always, but there have been certain cases where this has been seen in the industry and has led to overstatement of revenues and eventually in later periods correction of those overstated figures, which is why an analyst needs to keep in mind. Now, please understand why accounting standards have given this flexibility to businesses. Businesses are ever evolving. They're constantly changing and moreover venturing into new territories where they may need to define revenue based on their nature of products or services. Precisely why that flexibility is provided and where businesses tend to change their revenue recognition policies depending on the nature of change of their businesses or their new activities. So it's not always wrong where businesses, if they change their revenue recognition policies, it is our job to keep an eye out on why that change has been made, understand that change properly, and see if that change impacts any financial figures, especially pertaining to revenue and a couple of line items on balance sheet. Now, these line items on balance sheet or as well as revenue, if changed, an analyst should keep in mind how should they go about making those figures comparable across years. Now, this is something we are going to study in our next recording, next lecture. However, in this session of Financial Statement Analysis series, we are going to understand how to gather this knowledge on based of what facts or guidelines a business is defining its revenue. Now, to do that, let me take a very simple example of Asian Paints. Now, Asian Paints, this is annual report 2020 of Asian Paints business. Let's first understand I think each and every one of us has gone through session 1 and session 2. If you haven't, please do take a look at session 1 and session 2 of Financial Statement Analysis series before jumping into this session. Now, let's take a look at how Asian Paints presents its revenue. Now, I'll directly move to page number 209, where the income statement of Asian Paints is present. Let me just quickly zoom in for viewers' benefit. Right. So this is the presentation of income statement. As you can see, the revenue from operations has been split into a couple of line items here itself. So, either an analyst can go to footnote to verify if there are any sub items to revenue from operations and what those sub items are, and then identify what kind of products or services a business is rendering and see how they define revenue for those particular products and for those particular services is precisely what I'm going to show through this example. So let's take a look for Asian Paints. It looks like a simple business model where they're selling a couple of products or services. Majority of their revenue seems to be generating from sale of products. So let's open note number 23, which is present again on page number 249. So when I open page number 249, I see revenue from operations. Again, there is no further granular information provided. You can take a look at this though, like sale of products, paints and allied products, home improvement, and precisely these revenue from sale of products. Now, to understand how is it that they, are defining revenue when it comes to products and how they are defining revenue when it comes to services, an analyst needs to open revenue recognition policy from accounting policies. That is usually present just below the financial statements. So either I scroll up or I can directly navigate to page number 218, which is just below the income statement, cash flow statement, and balance sheet in the accounting policies section, where they have highlighted how is it that a business is recognizing revenue. Now, as you can see, this is the section which I was referring to, revenue. They have explained revenue from contracts is recognized on transfer of control of promised goods or services to a customer. So precisely as soon as they have transferred that particular product to customer, they are recognizing revenue. You can get more details in this section, sale of products. Revenue from sale of products is recognized when the control of the goods have been transferred to customer. Now, an analyst needs to keep in mind the word control here may have different caveats from company to company. Now, obviously, there is no further granular information available here, so we are going to take the word for it. But, one needs to keep an eye out for this data point. Moreover, the company defines the performance obligation in this case is satisfied the moment a sale is made. So, or rather when the shipping has been done to the customer. So precisely, even if let's say a company has manufactured a particular good or product and hasn't really shipped it to the customer, they won't be recognizing it as a revenue. Let's say if the customer hasn't paid and they have shipped that particular product to the customer, still the company will be recognizing it as a revenue or something which is known as a credit sale. So you will see a line item on balance sheet under trade receivables where, that much amount of money is liable on the customer's part to pay to the company for the products or services he or she has availed. Now, in terms of services, revenue from rendering services is recognized over a period of time by measuring progress made towards satisfaction of performance obligation for the services rendered. They use something which is known as milestone method. Now, let me explain what this milestone method is. Now, in terms of businesses, often they use for longer period contracts. So let's say, for example, I get a contract of I'm Asian Paints and I get a service contract for, let's say, a particular project, which may take different amount of time depending on how I'm executing it. So which is where often businesses or customers tend to put in a caveat: if you complete 25% of this project, you are liable for this much amount of money. Now, this is known as a milestone approach. Basically, on a predetermined progress milestone or a particular mark in the contract's lifetime will ensure you to receive a particular payment from customer. So if a contract is, let's say, for example, let's say you have a very simple contract of painting a 3-story building, and a customer says, if you paint the first floor of the building, you will get 33% of the payment. Precisely something like this. Now, this is a very, very simple example for viewers' perspective, but you get the point from this, hopefully. So which is where this is called a milestone approach. Depending on the progress predetermined and agreed upon with the company, the customer will pay you after verifying that progress the amount which the company is liable for. And the company will recognize that as a revenue. So in case if a company hasn't finished, or rather in this case has finished painting only, let's say 1.5 floor of that building, the company is liable to get only 33%, because the next milestone is, let's say, on the second floor, which will be further 33% increment to their existing revenue. So even if they have worked for it, but since that milestone hasn't been achieved yet, the company would be getting 33%. Let's say this contract of painting a 3-floor building was, I don't know, maybe a 50 lakh contract. In that case, you will be getting a 33% of 50 lakhs, which happens to be around 16 or 17 or lakhs. Precisely, hopefully, now you understand how the milestone approach works. Now, this was a very, very simple case study in terms of understanding how a business is defining revenue. Now, let's take another slightly complicated case study so that you get a flavor of how to go about, let's say, if you get any particular company for analyzing, you should be able to open its annual report, navigate through the presentation, the footnotes, and then concur based on the revenue recognition policies, how a business is defining revenue. Remember, an analyst always needs to keep an eye out for changing revenue recognition policies, which sometimes may be warranted due to change in business environments, or as a matter of fact, evolving businesses. Now, let's move to EROS. Now, this case study, again, this is the annual report 2020. Again, so let's go through the same process. The first step should be taking a look how the presentation of revenue line item has been done, so that you understand what basically comprises, or rather falls in the revenue of EROS. And then how is it that company is defining that to be a revenue line item is something we'll take a look at in revenue recognition policy. So let's first go through the same process. On page 108, you will see the consolidated income statement or a P&L statement of EROS. Let me just quickly zoom in for your benefit. As you can see, it's the same standard presentation format which we saw in our series 1 revenue presentation. Now, let's move to the footnotes, note number 30 and 31. Remember, why did we go to income statement first? Because we need to understand what falls under revenue, and that detail is present in this footnote, but we wouldn't really know the number of the footnote, which is why we need to go to the income statement. Now that we know footnote number 30 and 31 has more details around revenue, let's go to footnote number 30 and 31, which are present on page number 130. Now, when I open page number 130, you can see revenue from operations, sale, distribution, exhibition of film and other rights to be defined as revenue from operations. Now, precisely, the business is into a lot many things here, either sale of movie rights or film rights, as well as exhibition like movie theaters, and likewise distribution to other exhibitors. So let's take a look. How is it that in this diversified kind of varied products and services, the business is trying to recognize or define their revenues? So we need to take a look at the revenue recognition policies, which once again are present just below the financial statements in the accounting policy section on page number 113. Now, moving to this, you will see that under the revenue recognition section, the businesses has defined different criteria for different revenue streams. The first one is theatrical sales. Contracted theatrical sales are precisely defined based on something. So the business is very different when it comes to theatrical sales. They tend to define based on, a minimum guarantees that are recognized from theatrical release date. So for example, let's say EROS has a movie coming up and they sell those movie rights to the exhibitors or other theaters out there. Now, EROS, obviously, given the goodwill or the marketing or rather the hype of that movie, certain exhibitors, they would want exclusive rights or rather at least rights to, showcase or exhibit those movies in their movie theaters. Now, to get those, EROS may place a condition or rather usually places a condition of a minimum guarantee revenue, which these exhibitors are liable to pay, even if, let's say, for some weird reason, they are not able to sell as many tickets as they had thought of selling for that movie. Now, a minimum guarantee has to be provided. So for example, let's say there is this another movie XYZ, which is coming up. And EROS has placed a minimum guarantee of 1 crore for these exhibitors to pay, even if, let's say, they are not able to sell those movie tickets. What happens if they are not able to sell those movie tickets? They are still liable to pay this 1 crore to EROS, which is where as soon as the movies are given to the exhibitors, the group will recognize the revenue for the minimum guarantees. Is precisely what they are mentioning. What if the sales are in excess of the minimum guarantees? The group share of box office receipts in excess of minimum guarantee is recognized. So let's say if there is a variable component to it, like, if you make sales more than 1 crore, you pay me, let's say, 15 or 20% of each and every sale. And that's a variable component over and above that floor. So upfront, they will recognize the minimum guarantee revenue which they are generating by transferring, the exhibition rights to those exhibitors. And if they are able to sell more than 1 CR, for each and every ticket is sold, they are liable to get, let's say, the variable component whatsoever may be present in those agreements. So precisely how theatrical sales revenues are recognized. Interesting, right? Now let's move to television. Now, in arrangements of television syndication, license fees received in advance, which do not meet the revenue recognition criteria, including commencement of availability of broadcast under the terms of related licensing agreement, are included in contract liability until the criteria of recognition is met. So, for example, let's say if there is a TV show which EROS has given rights for these guys to air. Now, upfront, they may be paying a huge advance to EROS, but since the time frame of broadcasting that particular right hasn't yet expired, so let's say you get a movie broadcasting right for 5 years, and the company is getting paid for the same upfront, let's say 5 CR. So EROS cannot recognize entire 5 CR as revenue in the first year of sale of this broadcasting right. Why? Because just in case if something goes wrong, they may have to refund the fees because the guys had right to broadcast for 5 years. So according to revenue recognition policies, EROS will have to recognize only the proportion of what services EROS has delivered. So revenues from television licensing are recognized when the featured film or television program is delivered and the period for which exploitation of right has begun. So let's say in the first year of the contract, which is after 1 year, the contract has been utilized almost 20%, 1 by 5. So out of that 5 crores, EROS will be able to recognize 20% of that revenue, which is 1 crore in that particular year. So as the services are rendered for a long-term period contract, proportionately revenues are recognized. This is often known as percentage completion method. Like some of you guys may have heard of this. Percentage completion method means in case if you have delivered a proportion of the contract, you can recognize that proportion of the contract as your revenue if you're using this revenue recognition method. So precisely in case of, let's say, if a company is selling across broadcasting rights for 5 years and they are 1 year down the line into the contract, they will be able to recognize 20% of the revenue. Now, one may ask, what happens to the remaining 4 crore? Isn't that paid in advance to the business? Precisely, just think about it. It's sort of like advance to the business, which is often known as deferred revenue as well. So you will see this to be part of liabilities for EROS because that's essentially an advance paid to EROS for the services it hasn't yet delivered to the customer. So which is where that remaining 4 crore at the end of first year will fall under the liabilities. Hopefully that clears the picture. For people who are still thinking how assets and liabilities and equities are going to be balanced, let me just take a quick figure stab at it. So let's say at the start of 2020, 1st April, EROS sold a 5-year broadcasting contract to a particular customer for 5 CR on 1st April itself. So how the balance sheet is going to look: on the asset side, the cash will increase by 5 crores, and the liability side, the deferred revenue, or sometimes even in the new accounting standards, that line item is known as contract liabilities, will increase by 5 crores. So assets equal to liabilities plus equity with no impact on equity. Now, what happens at the end of this fiscal year 31st March 2020, because one fiscal year has gone by, sorry, it will be 2021. One fiscal year has gone by, the company has delivered what it was liable to deliver. In this case, what will happen? The liability will reduce by one because now the company has earned that revenue. And the company is recognizing it as a revenue on income statement, which eventually rolls back to equity. So liability will reduce by one and equity will increase by one. So the net liability balance at the end of the year is going to be 4 crore, precisely what I was talking about. In this entire scenario, A equal to L plus C remains to be balanced. Hopefully that clarifies the picture for you guys. All right, moving to the next revenue recognition policy here. For DVDs, CDs, and video distribution, revenue is recognized on the date the product is delivered or licensed in line with above criteria. Obviously, it's just like a sale of a product at a point in time, just like, you know, Asian Paints used to do for their products. Now, the same thing you can see for other line items as well. Hopefully, that gives you a very good picture how businesses tend to recognize revenue. Now, we will be taking one more example in today's session of Just Dial. Let me quickly browse you through that. Now, once again, the same approach will open the income statement of Just Dial to find out which footnote number has more details around how the revenues are extracted. So in Just Dial, you can find the consolidated income statement on page number 152. As you can see in front of you, let me just quickly zoom in a bit. Yeah. You will see that revenue from contract with customers. Now, this is a very interesting word, maybe perhaps hearing it for the first time. I'll talk about it. So let's say, for example, Just Dial is into businesses which provide web-based services to businesses to generate leads, customer leads. Now, they provide mobile application services, they provide web hosting services, moreover, advertising contracts, like, for example, I pay you 5 lakh rupees for a tenure of 5 years. And, you know, you give me leads whatsoever comes across those. And there's a variable component on a lead basis. Or as a matter of fact, let's say I pay you 5 lakh rupees to host my website for 5 years or something like that. You know, now these long-term arrangements with customers, as soon as, you know, a customer engages with you in a transaction, are often known as contracts. Now, which is where Just Dial seems to be generating quite a lot of its revenue from. Now, let's take a deeper look into these footnotes to understand what kind of contracts are we referring to here. So moving to the footnote 1920, you will find those on page number 175 of Just Dial. Now, if we take a look at 175 page number, revenue from contracts with customers, you will see a detailed breakup of those contracts. So sale of search related services. Now, search related services is like, you know, just in case if someone goes on Just Dial website and they search who is the, you know, nearest fertilizer provider, and your name pops up. Now, these are search related services. Sale of software and website services, hosting your website, or for example, providing you with mobile application services. Sale of review and rating, because often you may have seen in different restaurants that it has a Just Dial rating, or different businesses have Just Dial ratings. So for that ratings as well, they charge to their customers. And then transaction fees and commissions on different income on search plus services. Like, for example, if you give a call to Just Dial and ask for, that is basically a lead generation for that business, and that is something which they charge to their customers. Now, when you see these, it creates a very interesting perspective. How is it that they are defining revenue for each and every line item? For search related services, web-based services, rating services, how is it that they do so? How do rating contracts work? Like, do they recognize upfront revenue as soon as the rating is given? Let's take a look in the accounting policy section. Again, just like we discussed earlier, accounting policy section would be present just below the financial statements. So moving to page number 157, where you will see these details in the accounting policy section. When you move to page number 157, on the bottom side, right side, you will see revenue. Now, in the revenue, contracts from customers is recognized when control over services are transferred to customer at an amount that reflects the consideration to which group expects to entitle in exchange of those services. Precisely, as soon as the control is provided to customer, the group starts recognizing revenue. Now, that's a generic theme. Let's move piece by piece, each and every line item. Now, income from sale of search related services. Revenue from tenure-based contracts are recognized pro rata over the contract period. Again, this is very much similar to that of what we saw in EROS, the percentage completion method. So if a contract is of 5 years and you are 1 year into the contract, you will recognize 20% of that revenue. If you are 2 years into the contract, again, for that particular year, you will recognize 20% because 20% was recognized early. So every year you move into the contract, you are recognizing 20% of the revenue if the contract size is for 5 years. If the contract size is for 10 years, naturally it will move to 10% every year. And precisely how it works. However, please understand one thing, not all contracts are sold on 1st April. You may see certain contracts being sold on 1st January or the, let's say, 1st March, depending on that period which falls within that fiscal year. That particular length of the overall contract is pro rata basis, recognized as revenue. Hopefully that communicates in a detailed fashion how to go about analyzing revenues of long-term contracts. To talk about income from sale of software related services, revenue from sale of software licenses is recognized when the risk and reward of ownership have been transferred. Like for example, if I'm hosting, so revenue from hosting and related services is accrued over a period of time. Because remember, if I have, so let's say if I'm Just Dial, and let's say I get a customer who has asked for a 5-year contract on hosting his website, naturally I cannot recognize all the money he pays me upfront in the 1st year because I'm yet to render services worth 5 years. The proportion of that 5-year period which falls in this current fiscal year is what I'm going to recognize as a percentage of overall revenue which the customer is liable to pay. Now, in terms of software, subscription license is recognized as soon as the services are rendered. So subscription related services. So, because you have paid for the entire year, it's just like mobile recharge, because you have paid for, let's say, a 1-year recharge and you fall in the last quarter, that particular telecom provider cannot recognize your entire 1-year recharge as that year's revenue. They will have to recognize only that proportion of tenure of last quarter in the current fiscal year as a revenue for the money you have paid to the company, because the remaining 3/4 revenue or 75% will fall as a liability. Now, website related services, as you can see, most of the services which are provided by Just Dial are on a long-term contract basis. And these businesses tend to receive upfront money from customers because, let's say, if I want to have a mobile application, I'll have to pay upfront. If I want to have website hosting related services, I'll have to pay upfront. So the customer tend to provide a lot of money upfront, even if the contract is for 5 years. The charges are often, or rather the money is often paid by customers upfront, which is why when you take a look at balance sheet, a very interesting observation can come to you. Let me show you. Let me just quickly open page 151 on which the balance sheet of Just Dial is present. When you take a look at the liabilities section, you will see a significant amount of liabilities is sitting in a line item called other current liabilities. Now, one may get curious what exactly falls into this other current liabilities, which has almost 75% of overall liabilities of the business. Now, when you open note number 17, which is on page number 174, you will see that the other current liabilities, most of it is actually deferred revenue. Remember, we discussed this in EROS. If a customer is paying upfront, that is recognized as as liability or sort of like advance from customer or deferred revenue. Sometimes under new accounting standards, it is also termed as contract liabilities. Now, why is it called contract liability? Because you have engaged into a contract with the customer for which you have already received upfront payment and you're liable now to deliver on those services or products, which is why you get this deferred revenue. Now, when you take a look at this deferred revenue, if you add these two portions together, now there is a non-current portion and there is a current portion. Current portion would be, something which you are liable to deliver in the next fiscal year itself, and non-current would be beyond that because you have multiple year contracts, right? So when you add these two together, you will get somewhere around 33,000 lakhs, which matches directly with the contract liabilities balances. You can do the math, you will see it to be matching. Now, these are contract liabilities. As you can see, previous year as well, it existed. And naturally, they got new customers on board. So the contract liabilities balance increased. And at the same time, during the entire fiscal year, they also delivered on the promises. So the contract liabilities decreases based on the deliveries which you have made and is eventually recognized in as revenue in income statement, something which we discussed in the previous couple of minutes back in the EROS case study. Hopefully that answers your curiosity in terms of how businesses tend to define what exactly falls as revenue in their terminologies. Now, when you have understood how a business tends to define revenues, how to go about analyzing different revenue figures. What happens if a business has changed its revenue recognition policy over the years, and how to go about normalizing those impacts and make sure the data is comparable on a time series basis, or as a matter of fact, even cross-sectional basis. How to go about that is something we are going to discuss in the next series. So stay tuned. Please do like, subscribe our Instagram as well as YouTube channels. You will find much more informative content there as well. You can also read more about these on the blog in the forum section of Financial Statement Analysis series on our website. Again, feel free to comment in case if you have any queries. We'll be more than happy to answer. This is precisely what we discussed in today's session. I look forward to seeing you guys in the next session. Thank you so much for your time. Have a great day.